The world of finance can feel like navigating a dense jungle, overgrown with unfamiliar terms and complex concepts. For many, the seemingly impenetrable thicket of stocks and bonds represents the ultimate challenge. Yet, understanding these fundamental investment vehicles is crucial for anyone seeking to build long-term wealth and secure their financial future. This comprehensive guide will demystify stocks and bonds, explaining their characteristics, risks, and potential rewards, empowering you to make informed investment decisions. Stocks. Owning a piece of the pie. Stocks, also known as equities, represent fractional ownership in a publicly traded company. When you buy a stock, you become a shareholder, owning a tiny slice of that company's assets and profits. The value of your stock fluctuates based on the company's performance, market sentiment, and broader economic conditions. This inherent volatility is a defining characteristic of stocks, making them both potentially lucrative and inherently risky. There are two primary types of stock: common stock and preferred stock. Common stockholders have voting rights in company matters and receive dividends, a share of the company's profits, if the company chooses to distribute them. Preferred stockholders typically have no voting rights but receive priority in dividend payments and asset distribution in the event of liquidation. Preferred stock is often considered less risky than common stock, although it typically offers lower potential returns. Understanding stock valuation. Several methods exist for evaluating the worth of a stock. Fundamental analysis focuses on a company's financial statements, examining factors like revenue growth, earnings per share, EPS, and debt levels to determine its intrinsic value. Technical analysis, on the other hand, uses charts and historical price data to identify trends and predict future price movements. A combination of both approaches is often employed by experienced investors. The risks and rewards of stock investing. The potential for significant returns is a primary draw of stock investing. However, this potential is intrinsically linked to risk. Stock prices can fluctuate dramatically, leading to both substantial gains and significant losses. Market downturns, company-specific problems, and unexpected economic events can all negatively impact stock prices. Diversification, spreading your investments across different companies and sectors, is a crucial risk mitigation strategy. Dollar cost averaging, investing a fixed amount of money at regular intervals regardless of price fluctuations, can also help to mitigate the risk of buying high and selling low. Bonds represent a loan you make to a government or corporation. In essence, you're lending your money for a specified period, receiving regular interest payments, coupon payments, in return. At the maturity date, you receive the principal amount, the original amount you lent, back. Bonds are generally considered less risky than stocks, as they offer a fixed income stream and priority over stockholders in the event of bankruptcy. However, they typically offer lower potential returns than stocks. Types of bonds. The bond market is vast and varied. Government bonds, issued by national or local governments, are generally considered low-risk investments due to the perceived stability of the issuer. Corporate bonds, issued by companies, carry high